Okay, I know, another earnings breakdown, another company posting big numbers. I'm sure you've already heard this from some other videos. But Palantir's quarter isn't just good earnings. This is a company telling Wall Street, on record, we are going to grow 61% next year, while holding a 57% margin, while the stock still went down. Look, if you're short on time, or you just don't feel like listening to a cat doing earnings review, here's the one takeaway. Forget the revenue beat. Almost every AI company is beating revenue right now. What makes this print different is that Palantir might be the only company in software simultaneously guiding for accelerating hypergrowth and expanding profitability. Not one or the other, but both. And the reason the stock sold off anyway tells you more about where the market's head is at than it does about the business. That disconnect between what the numbers say and what the price did is exactly what we're unpacking today. But real quick, if you're new here, my name is DataCat. I spent years as a very average analyst inside a Fortune 50 company, basically living in messy data and models which most don't work. Think of me as the cat who finally knocked the laptop off the desk and said, if they're going to get rid of me in the next wave of layoff, maybe I should fire them instead. I've been running this channel for about 6 months now, so yeah, still pretty small, still figuring things out honestly. I'm not here to sell you a course, I'm not here to tell you I've got some secret formula. I'm just a guy who reads earnings reports the way most people read sports scores, and I want to share what I find. If that sounds useful to you, a like or a subscribe genuinely helps the channel grow. That's it. No gimmicks. Cats don't do gimmicks. We just stare at you until you comply. Alright, Palantir, let's get into it. So Q4 2025, revenue came in at slightly over $1.4 billion. That is 70% higher than the same quarter last year and 19% higher than last quarter. Full year 2025 revenue was around $4.5 billion, up 56% year over year. Now, here's what separates this from your average AI company beat estimates headline. Management didn't just celebrate the quarter and move on. They dropped guidance for fiscal 2026 at a midpoint of roughly $7.19 billion. That implies about 61% growth again next year. So this isn't a one-quarter sugar rush. This is the company saying on record, we expect the trajectory to hold. But, and this is the part that a lot of people gloss over, they're doing this without torching profitability. Q4 adjusted operating margin was 57%. Full year adjusted free cash flow was $2.27 billion at a 51% margin, and the 2026 guide implies they're holding that 57% adjusted operating margin while growing 60+%. I know some of you might find these numbers confusing. Just know that this combination is genuinely rare. They keep referencing what they call the rule of 127 instead of calling it rule of 40 this time, which is basically growth rate plus margin. It's their way of saying we are doing both at the same time and reaching new heights again, and we know how unusual that is. Now, I don't want to just drown you in numbers because honestly, if I wanted to do that, I'd still be in corporate making PowerPoints no one reads. So let me give you the core of why this matters. The US business remains as the engine. 77% of total revenue comes from the United States. US revenue crossed $1 billion for the first time, up 93% year over year. And here's the thing people miss. It's not just government contracts. US commercial revenue hit over $500 million, up 137% year over year. Government was $570 million, up 66%. So basically, commercial is actually growing faster than government right now. Why does that matter again? Because remember, the old knock on this company was always it's a government contractor dressed up as a tech company. That argument is getting harder to make when commercial is your fastest growing segment by a wide margin. And then there's the forward pipeline. Q4 total contract value bookings, $4.3 billion, up 138%. Remaining deal value and performance obligations both doubled. Net dollar retention hit 139%, up 500 basis points quarter over quarter. Even if you assume some lumpiness in those booking numbers, and there's always lumpiness, the direction is unmistakable. The pipeline is swelling. So, that's the good. And if I were a cat looking at a laser pointer, this is the part where I'd be fully locked in. But, you know what cats also do? We look behind the furniture. So let's calm down, take a step back, and look deeper. First, international. It's lagging, and it's not me saying that. The management basically admits it. Q4 international commercial revenue grew just 8% year over year. Full year, 2%, too. While the US side is putting up triple-digit growth. Alex Karp framed this as procurement friction, countries wanting to buy from domestic vendors. Plus, and I quote loosely here, Palantir saying they don't really have the bandwidth to do anything difficult outside of America. That's a remarkably honest statement. It's also a yellow flag. 77% US concentration means if anything disrupts US government or enterprise spending, budget fights, policy shifts, a broader macro slowdown, there's no international cushion to soften the blow. We've heard this before in the last earnings call, and Europe isn't suddenly going to wake up and fill that gap. Not this year. Second, bookings quality. Now, the headline numbers I just mentioned are massive indeed. But management also mentioned that some of that RPO growth was helped by significant long-term renewals with long-standing international customers. That's not bad on its own, but it's worth flagging because renewal-driven backlog growth and net new business-driven backlog growth are not the same thing. If a chunk of that surge came from big renewals locking in, that tailwind might not repeat every single quarter. So just keep that in the back of your mind when you see those booking numbers trending forward. Third, expenses are going up. The CFO was pretty direct about this. They expect operating expenses to increase in 2026 due to AIP investment and what they're calling elite hiring. Now, they're still guiding to GAAP profitability every quarter, so this isn't a panic situation. But here's the minor risk. If growth slows even modestly while OPEX is ramping, the operating leverage story can shift fast in the market's eyes, especially in a risk-off tape where people are already nervous. Margins compressing even a little on a stock trading at these multiples, that's the kind of thing that gives analysts an excuse to downgrade. It's not a base case problem, it's a sentiment fragility problem. Fourth, and this one's subtle, the growth is coming more from revenue per customer than from adding new customers. Their top 20 customers are now generating an average of $94 million per customer on a trailing 12-month basis, up 45% year over year. That's incredible wallet share expansion. But it also means they're going deeper with fewer logos rather than spreading wide. When this model works, it works beautifully. But it can also make individual quarters lumpier. Lose one whale or have a renewal slip by a quarter and the optics shift fast. It's like a cat who only hunts one type of bird. Great efficiency. But if that bird migrates, you're going hungry. Now, Karp actually addressed this dynamic on the call. He essentially said the revenue growth is, quote, inexplicable without similarly explosive customer activity. And the logic checks out when you look at the AIP bootcamp data. And actually, let me pause on the bootcamps for a second because I think this is one of the most underappreciated parts of the whole story. So Palantir runs these things called AIP bootcamps. Think of them as compressed, hands-on workshops where they take a customer's actual data, actual workflows, and show them what the platform can do in production. Not in a slide deck, not in a demo with fake data. These are real workflows, real results, and the numbers they shared are kind of absurd. One customer went from 100 users and 4 use cases to 16,000 users and 280 use cases. Another new customer did 2 boot camps and then signed a $96 million deal in the same year, another $80 million after demos. This is the part most analysts don't spend enough time on. These boot camps are essentially packaged conversion machines. They collapse the time to value, meaning the customer goes from, interesting to, okay, we need this across the entire org in weeks, not years. And this ties into something management keeps emphasizing, the commoditization of cognition. Their argument is that AI models themselves will keep getting cheaper and better. That's not where the moat is. The moat is in who can operationalize those models at scale, who can tie them into actual workflows, decision rights, audit trails, security, data governance, all of that boring but mission-critical infrastructure. Because let's be honest, every company on earth has tried an LLM demo at this point. The question is, who's actually running production workloads? And Palantir's pitch is, that's us. It's kind of like, you know how a cat can knock anything off a table? Every cat can do that. It's a commodity skill. The difference is, which cat can do it strategically enough to get you to stand up and open the treat cabinet. That's the moat. Operational leverage on chaos. Okay, one more thing before we get to the stock price. Shyam Sankar's section of the earnings call was quietly enormous. He wasn't just talking about winning contracts, he was describing Palantir becoming a default platform layer inside defense environments. Maven, edge agents, autonomous agent swarms, deployment across all combatant commands. This isn't project-by-project consulting work, this is multi-year platform entrenchment, and the de-risking implication is huge. Once you're the operating layer that warfighters and commanders rely on, the switching costs become almost infinite. You don't rip that out, you build more on top of it. So, when people say and describe Palantir as a government contractor, I'd push back and say it's closer to becoming defense infrastructure. And that's a meaningful difference. Right, now the elephant in the room. You post a 70% growth quarter with 57% margins, and the stock still drops hard. Makes no sense on the surface. But here's the thing, and this is something I think newer investors really need to internalize. The stock market prices expectations, not just results. In a risk-off week for high multiple software names, investors start demanding proof of durability. One great quarter isn't enough. They want to know, can this persist as the revenue base gets larger? Can the company scale delivery without hitting bandwidth limits? What happens if AI spending narratives cool off even slightly? And concentration gets penalized in these environments. When 77% of your revenue is US, and your growth is driven by going deeper with existing customers rather than adding thousands of new ones, the market sees that as less diversified. Fair or not, that's just how it gets repriced in a nervous tape. So you can absolutely have A+ earnings and still see the stock down materially from its highs. That's not a contradiction. That's just how markets digest uncertainty around valuation multiples. Okay, here's the part where you might be yelling at the screen, DataCat, should I buy it now? Alright, I'm not a financial advisor, this isn't financial advice, I'm literally a cat with a spreadsheet, but I can share the framework I'm looking at. On the evidence in this call, the fundamental picture reads as structurally bullish. Growth plus profitability plus bookings momentum, it's hard to argue against the business trajectory. The base case is that Palantir is in a US-led platform expansion phase where customers are consolidating workflows onto their stack. Foundry, AIP, the ontology layer, producing very high net dollar retention and very large deal sizes. Management's guidance implies they believe this is not peaking anytime soon. Now, as of February 6th, after the week's sharp drawdown and Friday recovery, here's a simple framework for thinking about price zones. The best value zone sits around $131 to $128. That 128 level is the observable 30-day liquidation low, a pretty extreme mean reversion area. If price decisively breaks and holds below 128, you're in new range discovery and the thesis needs re-evaluation. If you're okay accepting some volatility, the 137 to 132 range is showing oversold intraday momentum with an expansion pattern and momentum divergence. But, and I cannot stress this enough, oversold can stay oversold in a risk-off environment. You'd want to see confirmation such as holding behavior, higher lows and levels being reclaimed. For a lower risk, more patient approach, watching for price to reclaim and hold above 147 is meaningful. That's the first statistical line in the sand, where you can argue the move is shifting from a crash stretch toward mean reversion. If it holds above that level, dips into that zone become more buyable. And if the broader tape cooperates, mean reversion objectives would be 163, then 166, then potentially 187. So look, Palantir just delivered one of the strongest earnings prints in software. The business is working. The bootcamp flywheel is converting. Defense entrenchment is deepening. But the stock lives in a world where valuation, sentiment, and macro all have a vote, and right now those votes are messy. The near-term question isn't, is Palantir profitable? It clearly is. It's, can this growth rate persist as the base scales, and can they scale delivery fast enough to match demand without hitting a ceiling? That's what I'll be watching. And if you want to watch along with me, well, you know what to do. A like and subscribe, and smash that notification button for the next coming up video. Alright, that's it for this crazy week. DataCat out, and I'll see you in the next one.